Yes, welcome back everyone. Today we are going to start with a new chapter, that is your ratio analysis. Ratio analysis. What do you mean by ratio? Ratio means relationship between two figures. It may be any figure, two figures expressed in arithmetic terms is called ratio. Is called a ratio. What it means? Let us take assets, assets and liability. In your balance sheet, asset will be on the balance sheet. This is your balance sheet. In the balance sheet, we call it as credit and debit. In the P&L, we call it as debit and credit, right? In the balance sheet, we have liability and asset. Let's say, let's say we have liability share capital, let's say 10 lakh, 10 lakh, okay. Similarly, we should have an asset on the asset side for same amount. So these relationship will be explained by the ratio, in terms of ratio, in arithmetic terms, in numbers, right? We can take the relationship of liability, asset, or profits, or business to business. We can compare those things, right? So next, we understood what is ratio. Fine. What is ratio analysis? What is ratio analysis? Ratio analysis means we're basically analyzing the financial statement of the company. Before starting this chapter, you should be very clear with the financial statement. That is your trading and P&L and balance sheet. If you know these chapters very well, or not even very well, if you can differentiate what is asset, liability, what goes to trading, P&L, and how we treat them, it will be easy for doing this chapter, right? Yes. So ratio analysis means we are basically analyzing financial statements. Let's say Mr. A has a business and Mr. B also doing the same business, same kind of business. He can compare with this business. So let's say he earned profit of rupees 10 lakh and he earns 12 lakh. But here sales is 1 crore, but his sales is 2 crore. Like this, who is best now? Mr. A is the best, because he sell 1 crore goods and earns 10 lakh profit, and he sells 2 crore goods and earns 12 lakh profit. This kind of analysis we are gonna do this in this chapter, and we can compare within company, means 2016 profit this much and 2017 profit is this much. Is profit increased or decreased? Like this comparison we can do in this chapter, right? Yes, after this we have, what are the types of ratios? There are majorly four types. Liquidity ratio, we can call it as short term solvency ratio. And second one, solvency ratio, only for long term debts. And here it is short term solvency, means short term debts, and this is for long term debts. Fine. Next, turnover ratio and activity ratio. The fourth one is profitability or income ratio. Under that, under liquidity ratio, under major ratios we have sub ratios, okay. Under liquidity ratio we have current ratio and quick ratio. Under solvency we have debt equity ratio. total asset to debt ratio, proprietary ratio, and interest coverage ratio. Then we will learn in depth in few minutes, but we are going through this like that. Simply we should know what are the ratios we have. Totally we have 15 ratios to learn. One by one we'll go on. In the turnover ratio, we have inventory turnover ratio, trade receivable turnover ratio, trade payable ratio, working capital turnover ratio. And in the profitability, we have gross profit ratio, operating profit ratio, net profit ratio, operating ratio, and return on investment ratios. Let us start one by one and we will understand it one by one conceptually. Let us start with the first one, liquidity ratio. What do you mean by liquidity ratio? Liquidity ratio means, let us say you have a liability of rupees 10 lakh. You have a liability of rupees 10 lakh. You should repay it within 1 year. Within 1 year you should repay the loan. For that, what you will see, assets, how much asset I have for repayment of liability within a year. Within a year, it is called liquidity ratio. If I want to pay my liability within 1 year, how much I can pay? That is called liquidity ratio or short-term solvency ratio. Okay, in that we have sub ratios: current ratio or working capital ratio, quick ratio or acid test ratio. Current ratio means within 1 year, whatever the liability is there, can I pay that liability within 1 year? That is called current ratio. Quick ratio means within 3 months, can I pay my liability? That is called quick ratio. What is the formula for current ratio? Current ratio is equals current asset on current liability. Means how much ever I have current liability, within 1 year whatever I should pay for that liability, how much asset I have, so that I can pay my liability by selling these assets. Right. If I have 1 rupees liability, how much asset I have to pay this 1 rupees liability. Right. This is current ratio. What do you mean by quick ratio? Quick ratio is quick asset divided by current liability. Whatever my current liability, within 3 months I should pay for that liability, how much quick asset I have. How much quick asset I have. What do you mean by quick asset? Quick asset is nothing but current asset. Whatever the assets will give me benefit within 1 year minus inventory, prepaid expenses, and advance. Let me write inventory. I means inventory, prepaid expenses, or advance tax and advance tax. Advance tax. Right. So why we are eliminating inventory, prepaid expenses, advance tax from asset, current asset? So let me say current asset is cash, debtors, like this, stock, whatever prepaid expenses. Why we are eliminating these things? Because if I want to sell my inventory within 3 months, it is not possible. That's why I'm eliminating this. Prepaid expenses, whatever advance you have paid for your expenses, it is not gonna be refund. 99% it's not possible. In rare cases that may be possible, but we are eliminating here. Advance tax, obviously if you pay advance tax, they will not return it, they can adjust in the future tax also, right? That's why we are eliminating these three things, that is inventory, prepaid expenses, advance tax. If we eliminate those things, we will arrive at quick asset, we will arrive at quick asset. Did you understand? Did you understand? Shall we move on? Yeah, here we have some important note, some important note. Investment or trade investment. If you see any investment or trade investment in your question, it will be non-current investment. It will be considered as non-current investment and it is non-current asset. Fine. Next, if you see any current investment, short-term investment or marketable security in your question, it will be considered as current investment and it will be called as current asset. Okay, fine. The note number 2. If you saw any loose tools, stores and spares are not, these are not included in inventory. Whatever inventory is there, we will not include these two things. Right? Did you understand? Shall we go for the questions? Shall we go for the questions? Let us understand much better. Yes. Let us go for the question number 1. Question number 1. Solution is okay. The question is on the board. You can take down the question. Shall we read the question? Yes, sir. Calculate current ratio from the following information. They have given inventories, trade receivable, advance tax, cash and cash equivalents, trade payables, short term borrowings. Right. Shall I write the question once in the board? Okay. They have given inventory, trade receivable, how much? 50,000, 50,000. Advance tax, advance tax 4,000, cash and cash equivalent 30,000, trade payable trade payable 1 lakh. Fine. Short term borrowings, short term borrowings, that is bank overdraft, bank overdraft. How much? 4,000 they have given. What they have asked for, calculate current ratio, right? This is what they are asking. Fine. They have given inventory 50,000, trade receivable 50,000, advance tax 4,000, cash and cash equivalent 30,000, trade payable 1 lakh, short term borrowing 4,000. Calculate the current ratio. What is the formula? What is the formula for current ratio? What is the formula for current ratio? Current ratio is equal to current asset divided by current liability. So how will you calculate current asset? Let us see. Current asset is equals what they have given. Yes, inventory, it's your current asset, obviously. Trade receivable, also your current asset. Advance tax, it is also your current asset, right? Then cash and a cash equivalent, obviously it is current asset. Trade payable, trade payable is your current liability. Short term borrowings, yes, obviously it is your current liability, right? How much? 50,000 plus 50,000, then 4,000, then cash and cash equivalent 30,000. Total how much it became? Total 1 lakh, 1 lakh 34,000, 1 lakh 34,000. Put it in the formula. 1 lakh 34,000 is the current asset divided by how much is the current liability. How much is the current liability? Trade payable and short term borrowings. 1 lakh plus 4,000. 1 lakh 4,000 is the total current liability. 1 lakh 4,000. How much it becomes? 1 lakh 34,000 divided by 1 lakh 4,000. 1 lakh 34,000 divided by 1 lakh 4,000 is equals 1.29 is equals 1.29 is to 1. What it means, if you have 1 rupees liability, if you have 1 rupees liability, I have asset for 1.29 rupees. Yes, that completes your first question. Let us go for the question number 2. Let us go for the question number 2. Yes, the question number 2 is on the board. You can take down the question. Yes. Shall we read the question? Shall we read the question? Yes. Calculate liquid ratio. Liquid ratio means quick ratio. Quick ratio. Right. Calculate liquid ratio or quick ratio. What they have given, current liability for 50,000. Current liability for 50,000 and current asset is 80,000. Inventory is 20,000. Advance tax 5,000. Prepaid expenses 5,000. Right. We should calculate the liquid ratio or quick ratio. What is the formula? Sorry. Quick ratio is equal to quick asset divided by current liability. Is that right? Yes, obviously. So, how will we calculate quick asset? Quick asset is equals to whatever the current asset is there, from that current asset we will minus inventory, prepaid expenses, advance tax. So what is the current liabilities? I have given 80,000 minus inventory 20,000, 5,000 advance tax, prepaid expenses 5,000. Total 30,000 minus becomes 50,000. 50,000 is the quick asset. 50,000 is the quick asset divided by current liability. How much they have given? 50,000. So if you do this 1:1, it comes out 1:1. If you are having a liability of rupees 1, we have asset of rupees 1. It is equal, not more, not less. It is equal. That's fine, right? The question number 2 is done. You can take down the, yes, the question number 3 is on the board. You can take down the question. Let us read it first. They have given current ratio, quick ratio and inventory 24,000 and asked for current asset and current liability. So how will we calculate? How will we calculate? Let us see solution. First thing they have given ratios. Is that correct? Current ratio they have given. What is the current ratio formula? Current asset divided by current liability. Fine. Open up the ratios. 3.5 divided by 1. Then they have given quick ratio. Quick ratio. Quick asset divided by current liability. So quick asset is 2 divided by 1. So shall we assume current liability as x, right, and current asset as 3.5x, 3.5x. Can you assume that? Yes, obviously. Current quick asset, next is quick asset. Current liability is over. Quick asset, how much they have given? 2x. So what is the information? The only information they have given, inventory. So somewhere we will use the inventory. Where in the quick asset. From the quick asset, for the quick asset, to calculate quick asset we will use the inventory. Let us see. Quick asset is equal to current asset minus inventory. So now the only information they have given is inventory, right? Inventory is equals current asset minus, if it comes this side, comes like this, right? How much they have given inventory? 24,000 they have given. Is that okay? Yes. The current asset ratio is 3.5x minus 2x. If it get minused, comes 1.5x, becomes 24,000. Right. Fine. Then what will be the x? X is equal to 24,000 divided by 1.5. X goes this side and 24,000 divided by 1.5, right? A little mathematics. It comes out 16,000. So the liability is 16,000. Liability is 16,000. We got the liability. Fine. Let us do this. 16,000 we got the liability. 16,000 here also. So how will you calculate quick asset and current asset? How will you calculate quick asset and current asset? What I said earlier, if the current liability is 1 rupees, my asset is 3.5 times, right? If 1 rupee, if the current liability is 1 rupees, my current asset is 3.5 rupees. If my current liability is 16,000, then into 3.5 will be my current asset, right? How much it becomes? 16,000 into 3.5, 56,000. In the same manner, it comes out 32,000. Is that correct? We got current asset and current liability also we got. That's it. The question is done. You can write separately current asset this much 56,000 and current liability is 16,000. That's it. The question is done. You can take down the question. Yes, the question number 4 is on the board. You can take down the question. You can take down the question. Yes, let us read the question first. They have asked for current ratio, fine. Total assets they have given 3 lakh. Non-current liability 80,000. Shareholders fund 2 lakh. Non-current asset and a non-current asset, fixed asset they have given 1 lakh 60,000 and non-current investment 1 lakh. So let me write current ratio is equals to current asset divided by current liability. Can you able to see the current liability in the question? Let me check. Total asset, non-current liability, shareholders fund. No, there is no current asset. Fine. Is there any current liability? Obviously, there is no current liability at all. So, how will you calculate? So, how we can calculate? Let us take the help of the balance sheet. It's a rough work balance sheet. In the company, they have made a vertical balance sheet and everything. So now these balance sheets are not in the company, but we can do for the workings, right? This is your liability, this is your asset. Fine. In the balance sheet, first we will have shareholders fund, then we will have non-current liability, and then current liability. And in the asset side, non-current asset, and we will have current asset. We will have current asset in the balance sheet. Let us check what are the informations they have given. First, total assets they have given. Fine. This is your total asset. If total asset is 3 lakh, simultaneously the liability will be also 3 lakh. It must match, right? If asset is 3 lakh total balance, the total liability also will be 3 lakh itself, right? Non-current liability they have given 80,000 rupees. Fine. Then shareholders fund they have given 2 lakh. Fine, sir. The next information is non-current asset. Both are non-current asset itself, non-current investment and fixed assets also non-current asset itself. 2,60,000. 2,60,000 they have given. Fine. If total asset is 3 lakh rupees, then if we minus non-current asset in that, what will be the remaining? 40,000 remaining will be the current asset. It is your balancing figure through we find out that. Fine. Then if we have current liability, total liability is rupees 3 lakh. If we minus shareholders fund and the non-current liability in that, what will be the remaining? Obviously, current liability is the balance. 3 lakh minus 2 lakh 80,000. It is 20,000 current liability. Do you get the answer? Yes, fine. We got the answer. So, what is current liability? It is 20,000. Current asset is 40,000. It comes out 2:1. Right? 2:1. If you have current liability for 20,000, I have 40,000. So that 40,000 asset, so that I can sell these assets and repay the liability. That's all the question. Shall we move on to next topic? Next topic. So, our next major ratio is solvency ratio. So, previous one for the short term loans, but this is for long term loans and debts. If I say debts here, it means long term debt itself. Right. The first, under our major ratio, solvency ratio, we have four other sub ratios. First one is debt equity ratio. Debt equity ratio. Second one, total asset to debt ratio, proprietary ratio, and interest coverage ratio. The first one, debt equity ratio. Basically we are gonna compare debt, how much debt we have and how much owner's capital is there. So equity means shareholders, so share capital plus reserves and surplus is called equity. The first thing here, debt means long term debt, equity means shareholders fund plus reserves and surplus. Is that correct? Yes, obviously correct. If it is 2 is to 1, it is considered as safest ratio. 2 is to 1 means, if let's say if owner invests 100 rupees, if owner invests 100 rupees, and then the debt is long term debt is rupees 200, that's completely safe, that there is no problem at all. Then debt, debt means long term borrowings, whatever the long term borrowings, bank loan, we can take an example, plus long term provision becomes debt. What is this long term provisions? Long term provisions are certain amount we have kept aside for the future liability, for the future liability, that is called your long term provisions. Then equity means share capital plus reserves and surplus, already I told you. Then the second one, the second one is total asset to debt ratio. Total asset to debt ratio. What it means? What it means? The formula is total asset divided by long term debt. So you already understood that for long term debt, whatever the liability I have, for that how much total assets I have, so that I can sell these assets and repay the long term loan. It is called total asset to debt ratio. Basically we compare total asset and long term debt. And the third one, proprietary ratio. Proprietary ratio, what it means? Let's see the formula and understand it. Equity divided by total assets. Equity divided by total assets. So I didn't understand the formula. Means, this formula means equity, whatever the shareholders fund is there, owners fund, that's fine. Total asset means non-current asset plus current asset. Let's say total asset is 100 rupees. Total asset is there for 100 rupees. Out of that, how much owner's contribution is there? How much owner's contribution is there? That we will compare in the proprietary ratio. Then we have interest coverage ratio. The name only suggests that if we take any loans, borrowings, anything, we should pay the interest out of profit. How much we earn profit and how much we are paying the interest. It basically comes in the percentage. In the percentage. Yes, the four things we have understood. Shall we go for the questions? Shall we go for the questions? Let's understand more clearly by questions, right? Yeah, the first question in debt equity ratio is, take down the question. Take down the question. They have given balance sheet. Pause the video and take down. Yes, let us discuss the question first. So ABC Limited balance sheet they have given. In the liability, shareholders fund, share capital, reserves and surplus, money received against share warrant amounts. Fine. And non-current liability they have given, and current liability. Fine. In the asset, it is your vertical balance sheet. Non-current asset is 1,50,000. Sorry, non-current asset they have given, current asset they have given. So what is the formula? What is the formula for debt equity ratio? Debt equity ratio. What is the formula? First, debt divided by equity. Fine. Let us calculate the debt and equity. Fine. Let us see the debt first. Non-current liability will be the debt. How much? 4 lakh. 4 lakh plus 40,000 plus 60,000. 4 lakh. 5 lakh it is. 4 lakh plus 40,000 plus 60,000. It's very simple. Got 5 lakh. Right. 5 lakh is the debt. In the same way, how much is the equity? How much is the equity? 12 lakh plus 2 lakh plus 1 lakh. 14 lakh is the equity. 14 lakh is the equity. Shall I write it? 12 lakh plus 2 lakh. Sorry, plus 1 lakh. Sorry, it is 15 lakh, right? Yes. Plus 2 lakh plus 1 lakh. It comes out 15 lakh. Not 14 lakh. It comes out 15 lakh. Is that correct? Yeah. Shall we do 5 lakh debt is there and owner's fund 15 lakh is there. If I divide it, 5 lakh divided by 15 lakh, it comes out 33.33 percentage. 33.33 percentage. That means in your capital, debt is 33.33 only. Is that correct? Yes, that's fine. Completely all right. If you want to write it in ratio, you can write it 0.33:1. If your equity is 1 rupees, owner's capital is 1 rupees, the debt is 0.33 rupees. That's it. The question is done. Looks very big, but solution is 2-line solution. That's it. We can take down it. Next question is on board. You can take down the question. You can take down the question. Let us read the question first. What they have given? They have given balance sheet. In the balance sheet, share capital they have given reserves and surplus, non non-current liability and current liability, non-current asset they have given, current asset they have given. What they are asking, debt equity ratio and total asset to debts, and it is total asset to debts ratio. Okay, then asking proprietary ratio. So one by one we'll do. The first thing, debt equity ratio. What is the formula? Debt equity ratio is equal to debts divided by equity. Is that correct? How much debts we have? Long term borrowings 1,50,000. 1,50,000. It's, did I write 15 lakh? I did written. 1 second, let me check that amount. Yes, that's 1,50,000, not 15 lakh. 1,50,000. Is that correct? Yeah. Debt is 1,50,000. Fine. How much equity is there? Share capital plus reserves and surplus. Total becomes 5 lakh. What is the ratio comes out? Just a second. 1,50,000 divided by 5 lakh comes out 0.3 is to 1. 0.3 is to 1. Is that correct? Yes. The next one, total assets to debt ratio. Total assets to debt ratio is equals to total asset divided by debts. Yes. How much debt we have? We have 1,50,000. And the total assets, how much? Total assets 5 lakh. Non-current asset, current asset 2 lakh. Total 7 lakh. 7 lakh. Is that correct? Yes. How much it comes out? 7 lakh divided by 1,50,000. It comes out 4.66 is to 1. Is that correct? If you have 1 rupee liability, I have 4.66 rupees to pay that liability. Yes. Next. Third one. Proprietary ratio. Okay. Proprietary ratio. What will be the formula? Proprietary ratio is equal to equity. The formula, equity divided by total assets. Yes, fine. The formula is, for proprietary ratio, equity divided by total assets. Equity divided by total assets. How much equity we have? 5 lakh. Divided by how much total asset is there? 7 lakh. Simplify. Divided by 7 lakh. 0.71 is to 1. 0.7, let me write properly. 0.71 is to 1. This is the ratio comes out from proprietary ratio. Then we have one more. So the next we have interest coverage ratio. Take down the question. Let us see what they have given. Net profit after tax they have given. Okay, 15% long term debt. Fine. Tax rate 40%. Okay, what is the formula for this? What is the formula for this? Solution: net profit before interest and tax. Net profit before, yeah, we can take it as profit before interest and tax divided by interest. Right, this is the formula for interest coverage ratio. So, do they given profit before interest, profit before interest and tax? No, they didn't give. They gave profit before, sorry, profit after tax. That's fine, okay. 15% interest, that's okay. If we calculate 15% on 10 lakh, how much it comes out? No, just a second. First, before that, we should calculate profit before interest and tax. Interest is obviously 10 lakh into 15% only, but still we will calculate that later. But first, we will calculate profit before interest and tax. So, how will we calculate? How will we calculate? First, profit before interest and tax. From this, if we minus interest, we will get profit before tax. Fine. Then if we minus tax amount, we will get profit after tax. Profit after tax we will get after tax deduction, right? But straight away they have given profit after tax rupees 60,000. Is that correct? Yes, yes. Do we know the interest? 10 lakh into 15%, it is 1 lakh 50,000. How it comes? 10 lakh into 15% is the interest. Fine. Do we know the tax? Do we know the profit before tax? No. Do we know the tax? Yes, 40% they have given. Yes, by this information we can calculate. Let us assume profit before tax as X. Fine. If we minus 40% from this X, means 40 means 0.40x. If we minus, the remaining is the 60,000 is 60%, right? Remaining is the 60%, right? It comes out 0.60x. If profit after tax is 0.60x, let me write 0.60x is equal to 6 lakhs. Is that correct? If it is equals to 6 lakh, then if what is x is equal to 6 lakhs divided by 0.60. How much it comes out? 6 lakhs divided by 0.60 is equals to 10 lakh. 10 lakh, it comes out. Profit before tax is 10 lakh. Another way is there to find out this. Simply 60,000 is the 60% amount. How much is the 100%? If we did do 60,000 divided by 60%, sorry, it is 6 lakhs, right? 6 lakhs. No, 60,000. Profit after tax is 60,000. Then how much it should come? No, it's not 6 lakhs. It is 60,000, right? 60,000. 60,000 divided by 0.6. It is 1 lakh. It is 1 lakh. That's fine. Okay. It is 1 lakh. Okay, fine. 60,000 divided by, if you do 60,000 divided by 60%, It comes out straight away 1 lakh. Is that right? Okay, fine, 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 fine. From that 40,000 is the interest. And how will you calculate PBIT? PBIT, profit before income tax. Sorry, interest and tax. If we add these both, profit before tax 1 lakh and interest is 1 lakh 50,000, it comes out 2 lakh 50,000. 2 lakh 50,000 minus interest 1 lakh 50,000, profit before tax 1 lakh. That's it. The profit before tax came out 2 lakh 50,000. Right. How much interest is? How much interest is? 50, sorry, 1 lakh 50,000. 1 lakh 50,000 is the interest. What is the result? 2 lakh 50,000 divided by 1 lakh 50,000. 1.66. 1.66 is to 1. Right. What we can understand here, if we pay interest of rupees 1, we are earning 1.66 rupees. Right. Not much profit, but still okay. Right. We have completed this question, and we'll move on to next topic. Yes, let us start the another major ratio, activity or turnover ratio. What is activity? Activity is nothing but your sales, purchase, trade receivable, trade payable. These are the activity of a business in a normal course of business, right? Why we will use this ratio? Why we will use this ratio? The ratio is used to measure the efficiency of various operations. Why we will use? We will use to measure the efficiency of various operations of a business. Right, various operations means operations is nothing but same: sales, purchase, trade receivable, trade payable, working capital, like this. These are the various operations. Okay, then what we will get to know through this ratio? What we will get to know through this ratio? We will get to know how effectively we are using our resources, whatever the resources available with us, and how will we use those resources. That we will know through these ratios. So on the what basis we will calculate? On the basis of revenue from operation, means sales. It is nothing but your sales, or cost of revenue from operation. It is nothing but cost of goods sold. Is that right? Okay, fine, sir. Under this ratio, major ratio, we have sub ratios, 4 sub ratios. What are those? Inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, and working capital turnover ratio. Let us understand these ratios one by one. Let us start. Yes, let us start with the first ratio. Inventory turnover ratio. Means we will know how much times we converted inventory into revenue. I think I have written here. Okay. Basically, we will compare cost of goods sold with the average inventory. Fine, sir. We will know how much times we have, that I told you, inventory into revenue. Cost of goods sold. Wait a second. Let's go to the formula. Inventory turnover ratio is equals cost of goods sold. cost of goods sold. Whatever the goods sold, how much cost you have incurred, and average inventory. Average inventory means how much inventory you keep on an average in the godown. That we will know. Average inventory is equals, or we will calculate opening inventory. Opening inventory, let's say 100 rupees, and in the closing inventory it was 80, divided by 2, 90. It comes 180 divided by 2, 90. On an average 90 inventories we will keep in the godown. That's the meaning. Next, should calculate cost of goods sold. How will you calculate? Sales minus gross profit. Sales minus gross profit, or else if sales or gross profit not given, we have another method. Opening inventory plus purchases, that to net purchases. Net purchases means purchase minus purchase return will be net purchases. Is that okay? Plus direct expenses minus closing inventory. Through this we can get the cost of goods sold. Right, done. So the second one, trade receivable turnover ratio. Trade receivable turnover ratio means how frequently we will receive our money from the debtors. How frequently we will receive the money from the debtors, that will be known by calculating trade receivable turnover ratio. The formula is net credit sales. Net credit sales, how much you have sold in a, on the basis of credit, and average trade receivable means at one time how much you will receive on an average. Right, for example, if you sold 1 lakh rupees worth of goods on credit, and average trade receivable at one shot you may receive 25,000 on an average. Okay, fine. That means you will receive 4 times in a year. 4 times in a year from your debtors. This is known as how frequently you receive your money. Let's go for the next one. Trade payable turnover ratio. It means how frequently you pay to the creditors. Right? How frequently you pay to the creditors. And let us see the formula. Trade payable turnover ratio, net credit purchase. How much you have purchased on credit, and on an average trade payable. At one shot you will, how much you will pay. That is average, on an average. Right, okay, fine, that's completed. Next one, working capital turnover ratio. Working capital turnover ratio means how frequently, sorry, how effectively or efficiently you will use your working capital. That is working capital turnover ratio means. Okay, working capital turnover ratio, how will we calculate? Net sales, that is sales minus sales return, divided by working capital. How will you calculate? What is working capital? Basically, current asset minus current liability is the working capital. Yeah, written here. Can take it down this, and we'll move on to questions. Yes. So, question 1 is on the board. You can take down the question. Yes, let us read the question first. They have given inventory in the beginning of the year 18,000, in the end of the year 22,000. Net purchases means purchase minus purchase return. Already purchase return is minus 46,000. They have given wages 14,000, revenue from operation 80,000, carriage inward 4,000. Calculate inventory turnover ratio. So we should calculate inventory turnover ratio. Fine. What is the formula for inventory turnover ratio? Is equals cost of goods sold divided by average inventory. First, let us calculate the average inventory. Average inventory is equals opening inventory plus closing inventory divided by 2. Is that correct? What is opening inventory? We have 18,000. Closing 22,000. We'll add both and divided by 2. How much it comes out? 40,000 divided by 2. 20,000 is the average inventory. 20,000 is the average inventory. Is that okay? Yes, sir. Yes, yes, yes. What is how will we calculate cost of goods sold? Cost of goods sold. Sales minus gross profit, or another method is there. What is that? Net purchases plus wages plus revenue from operation, not carriage inward. Is that correct? Yes. Net purchase, how much it is? Net purchases plus wages, then revenue from operation, no, carriage inward, carriage inward, and two more things are there. Opening inventory plus opening inventory minus closing inventory. How much? Net purchase 46,000 plus wages, how much they have given? 14,000, then 4,000, 18, 18,000 plus 22, sorry, minus 22,000, minus 22,000 is equals, how much it comes out? Let me calculate. Yes, 46,000 plus 14,000, 4,000, 18, 22,000. How much it comes out? 60,000 it comes out. 60,000. Yes, right. 60,000. Yes. How much it comes out? How much times? 3 times. That's it. The question 1 is done. Shall we go for the question number 2? You can take down the question solution. Yes, the second question is on the board. Let us discuss the question. What they have given: revenue from operation, fine. Average inventory, straightforward. Gross profit, okay. There is nothing to do with this. Okay, ITR is equals cost of goods sold divided by average inventory. Right. Average inventory they have given 55,000. Cost of goods sold, COGS. They have given sales minus GP. That's it. Sales, how much they have given? 4 lakh minus 10%. Minus 10% means the remaining cost of goods sold is 3 lakh 60,000. 3 lakh 60,000 divided by 55,000. How much it comes out? How much times it comes out? 3 lakh 60,000 divided by 55,000. 6.54. 6.54 times. The question number 2 is done. We can take down the solution and question also. Yes. The question number 3 is on the board. Let us read the question. They have given average inventory, ITR, the income turnover ratio, and 20% profit on sale, find gross profit. They are asking for gross profit. Okay, let us open the solution. Let's open the formula first. ITR is equals to cost of goods sold divided by average inventory. Okay, ITR is 8 times is equals cost of goods sold, we don't know, divided by average inventory. They have given 40,000. If we cross multiply, if we cross multiply, that is 40,000 into 8, sorry, 40,000 into 8, it comes out 3,20,000. Is that correct? 3,20,000 is the cost of goods sold. 3,20,000 is the cost of goods sold. 40,000, it comes out 8 times. We got the cost of goods sold, but they are asking gross profit. For gross profit, we should know the sales. So we know cost of goods sold, 3,20,000 if cost of goods sold, and if they are giving 20% profit on sale, you maybe remember a table. You maybe remember a table. 100 if it cost sales 50, 50, 33.33, 25, 20, 33.33, 25, 20, 16.667. Do you remember this? Did you remember this? Yes, 20% on sales. They are giving 20% on sales, right? If they are giving 20% on sale, you can, it will be 25%, or straight away you can do this. That's it. 3,20,000, that is 20% on sale, right? Sale is 100% minus 20% is equal to 80. 80 will be divided is equals to 4 lakh. It comes out straight away. It comes out 4 lakh is the sales. Out of that, if they are keeping 20% margin, if they are keeping 20% margin, how much it comes out? 4 lakh into 20%. 4 lakh into 20%. 1 to 20%. It comes out 80,000 gross profit. 80,000 gross profit. The question is done. You can take down. You can take down. Yes. The question number 4 is on the board. Shall we read the question? Yes. Total revenue from operation. Total revenue from operation is 4 lakh. That is credit sales and cash sales. Both, and cash revenue from operation 20% of total revenue. Whatever the total revenue is there, out of that 20% is cash sales. Okay, trade receivable. Opening trade receivable 40,000. Closing trade receivable 1,20,000. Calculate trade receivable turnover ratio. Yes, shall we? Yes. Solution. Trade receivable turnover ratio is equals credit sales divided by average trade receivable. Average trade receivable. So average trade receivable, shall we calculate? Average trade receivable is equal to opening plus closing divided by 2 is equals 40 plus 1,20,000 divided by 2. It comes out 1,60,000 divided by 2. How much it is? 80,000, right? 1,60,000. Yes, 80,000 is the average trade receivable. Okay, how much is the credit sales? How much is the credit sales? from total sales whatever they have given, total sales is equal to 4 lakh into cash revenue from operation 20% of 4 lakh, 20% of 4 lakh, how much it is? 4 lakh into 20%, 80,000, 80,000 is equals 3 lakh 20,000 is the credit sale. 3 lakh 20,000 is the credit sale. 3 lakh 20,000. 3 lakh 20,000 divided by 80,000. It comes out 4 times. Comes out 4 times. The question is done. You can take down the solution. Yes. The question number 5 is on the board. Shall we discuss? Yes. They have given creditors, bills payable, outstanding expenses, inventory, debtors, bank, cash. Calculate working capital turnover ratio. Calculate working capital turnover ratio. What is the formula? What is the formula? Sales divided by working capital. So, working capital is equal to current asset minus current liability. Fine. Yes, it's completely all right. Yes. Shall we calculate? So, what is the working capital? What is the working capital? Current asset minus current liability. Is that correct? This is current liability. This is your current asset. We should total and minus it. Total and minus it. One more point is missing. Just a second. One more point is missing here. Revenue from operation is 30 lakh. Where would I write? Revenue from operation 30 lakh. Yes, that's correct. Now it's fine. Shall we calculate? Sorry. Creditors is 1 lakh 40,000. Fine. 1 lakh 40, 1 lakh 90, 2 lakh it is total. Current liability is 2 lakh. Current liability is 2 lakh. Total assets 1 lakh 80, 2 lakh 80, 2 lakh 90, 3 lakh 70, 4 lakh. 4 lakh is current asset and 2 lakh is current liability. Working capital is 2 lakh. Working capital is 2 lakh and revenue from operation it is 30 lakhs is equals how much it comes out? 30 lakh divided by 2 lakh. 15 times. It comes out to be 15 times. Yes, you can take down. We'll move on to next question. Yes. The question number 6 on the board. Shall we discuss the question? Yes, sir. Revenue from operation. Revenue from operation. They are given 8,75,000. Creditors 90,000. Bills receivable 48,000. Bills payable 52,000. Purchases for 4,20,000. Trade debtors 59,000. You should calculate trade receivable turnover ratio, trade payable turnover ratio, average collection period. I will explain it. Average payment period they have given. Let us calculate these things. First, trade receivable turnover ratio. Trade receivable turnover ratio is equals, what is the formula? What is the formula? Trade receivable, credit sales divided by average trade receivable. Is that correct? Yes. How much credit sales they have given? revenue from operation, nothing is mentioned, we will consider it as totally credit sales. 8,75,000, 8,75,000 divided by average. What is average? Creditors, no. Bills receivable, bills payable, purchases, trade debtors. Average trade receivable, how much? Opening plus closing divided by 2. They didn't give any information about average and all, opening closing, didn't give anything. So we will consider bills receivable 48,000 and trade debtors, that is your trade receivable, it becomes your trade receivable. How much? 59,000 plus 48,000. 59,000 plus 48,000. So what will be the 1,07,000? 8,75,000 divided by 1,07,000. 8.17. 8.17. Now they have given average collection period. Average collection period means on how many days or months or in a week we will receive the amount. We will receive the amount. Let us calculate. 365 we can calculate in days or in months or weeks. 52 weeks, right? Divided by trade receivable turnover ratio. So let us take 12 months. Let us take months itself, or ratio is in 0.17, right? We can take days. Divided by 365 divided by 8.17. In how many days we will receive? 365 8.17 is equals to 44, or we can round up 45 days once we will receive the receivable from the debtors, right? Okay, fine. Next, trade payable turnover ratio is equal to, trade payable means credit purchase, it will be credit purchase divided by credit purchase divided by, what will be the formula? Average trade payable. Average trade payable, right? Let me calculate how much creditors, bills payable, purchase. Completely we can assume it as credit purchase. 4,20,000 divided by average trade payable. Average trade payable, bills payable plus creditors, 90,000 plus 52,000. 90,000 plus 52,000. 1,42,000. Okay. 4,20,000 divided by 1,42,000, right? 42,000. 2.95, and we should calculate average payment period. Let us take 365 days divided by 2.95, right? 365 days, 2.95, 123 days. 123 days it comes out. Yes, you can take down the solution. Let's move on to next. Let us move on to next major ratio is profitability ratio. The name suggests that how much profit we can earn in a business, that will be shown or calculated in the profitability ratio. The ability to earn in a business, that will be calculated, right? In the major head profitability ratio, we have sub ratios. GP ratio, net profit ratio, this is gross profit ratio, net profit ratio, operating profit ratio, operating ratio, return on investment ratio, or return on capital employed. Whatever we have employed a capital for that return. Yes, to understand this, first you should know trading and P&L account. You should know trading and P&L account. Let us understand this. First, trading account. In the trading account, we will we will record the transactions which are directly related to the manufacturing of a product, directly related to the manufacturing of a product. For example, here only, to opening stock, leave that, to closing stock, stock opening and closing, fine. Purchases, is it direct to the manufacturing of the company? Yes, absolutely. If we purchase the raw products, we can produce the product, right? Finished goods. Yes. And direct expenses like your factory cost, factory rent, factory, it may be wages and inwards, like these direct expenses will be debited in trading and P&L account, sorry, in trading account. And we have sales directly attributable. Yes, absolutely, we will minus the sales return, and here purchase minus purchase return, we will net it. We will write the net amount of purchase and sales. In the end, let's say some amount are there. If we minus whatever on the credit side to debit, that is credit minus debit, if we do, we will get gross profit. If we minus expenses on income, if we minus expenses on income, we will get gross profit, not net profit, it is gross profit. Then the gross profit will be brought forward to P&L account, brought forward to P&L account. And then in the P&L account we have operating expenses. So operating expenses means other than factory expenses, it may be office expense or selling and distribution expenses, administration expenses, like these expenses we will debit in the P&L account. We will call it as operating expenses. Then if we have any operating income like discounted received, something like that, we will credit that side, and we will get, if we minus the expenses on income, we will get operating income. This is called operating income. Then in the P&L account only, we'll brought down the operating profit. We'll brought down the operating profit. In that operating profit, we will reduce non-operating profit like loss by fire, loss by theft, like these abnormal losses, we will call abnormal losses we will minus from the operating profit. Then if there is any operating income, we will add to the operating profit. Then if we minus expenses on income, we will arrive at net profit. This is your trading P&L account. If you understand well, if not, formulas are there, you can do that. Yes, let us start one by one. Let us start from GP ratio, gross profit ratio. We have question on the board. Let us read the question first. You can take down the question. Revenue from operation and cash revenue from operation means cash sales is 25% of total revenue. 25% of total revenue. Okay, fine. Purchases, they have given opening inventory, closing inventory. Calculate gross profit ratio. Let us go to the solution. So what is the formula for calculating gross profit ratio? Gross profit divided by sales into 100. Sales into 100. Fine. Shall we calculate the sales? Fine. What is the formula for credit sale plus cash sale is equals total sales is equals total sales. They have given credit sale 3 lakh, but cash sale is 25% of total revenue, means total sale, 25% of total sale. Okay, fine. We don't have total sales. Fine, we should calculate that. If cash sale is 25% of total sale, so it means 3 lakh, the credit sale is 75%. Is that correct? Is that correct? Then what is the total sales? What is the total sales? Just 3 lakh divided by 75% is equals total sales is comes out 4 lakh. We got the sales. We got the sales 4 lakh rupees. Fine. We should find out gross profit. To find out gross profit, sales minus cost of goods sold. Whatever the expenses are there, we will minus from the sales. Is that correct? We will get gross profit. So what is the sale? 4 lakh. Fine. What is the cost of goods sold? What is the cost? Purchase plus opening inventory minus closing inventory. Cost of goods sold is equals to opening plus purchases minus closing is equals, what is the opening amount? 10,000 plus purchased for 3 lakh 20,000, 3.2 lakh minus inventory 50,000, 50k is equals, how much it comes out? 3 lakh 30 minus 22 lakh 80,000 is the cost of goods sold. Is the cost of goods sold. If we minus cost of goods sold from sales 2 lakh 80,000, we get 1 lakh 20,000 gross profit. We get gross profit of rupees 1 lakh 20,000. Shall we calculate this 1 lakh 20,000? Is that correct? Yes. So it becomes 1 lakh 30,000 divided by 4 lakh into 100, 30%. What it means? If we sell 4 lakh rupees, we will earn 1 lakh 20,000. Means if you sell for 100 rupees, you get 30 rupees profit. That is your 30% gross profit. Is that correct? You can take down the solution. We go for the next question. So next we have question number 2. Let's read the question. Sales revenue from operation is 4 lakh. Gross profit ratio 25% on cost. On cost they have given. Fine. You can use the table or straightforward you can take down. Right, solution. So what is the formula? Gross profit divided by sales into 100. Is that correct? Yes. What is gross profit given? 25% on cost. Okay, we have sales. Fine, 4 lakh into 100. That much we know. Gross profit is 25% on cost. Fine. 4 lakh into 25 divided by 125. 25 divided by 125. straight away it comes out 25 divided by 125, 80,000. 80,000 is the gross profit. 80,000 is the gross profit. 80,000 divided by 4 lakh into 100, it comes out 20%. 20% is the gross profit ratio. You can take down the solution. Next, yes, the question number 3 is on the board. You can take down the question. Let us read the question, what they have given and what they have asked for. Sales, they have given 8 lakh rupees, gross profit 25% on cost, fine, office and administration expenses 20,000, selling expenses 28,000, loss by fire, not 5, it is fire 10,000. Calculate operating profit ratio. What is the operating profit ratios? Formula: operating profit divided by sales into 100. Okay, straightforward. They have given sales. Okay, we took that. Fine. We need operating profit. What is operating profit? Shall we do the trading account to understand that? Trading account or not? Sorry. Trading account is not existing in the company accounts, right? We prepare SOPL account in the companies. So for the understanding purpose, we are keeping this format. Okay, trading account. Fine. Trading and P&L account. Sorry, trading and P&L account. Fine. What informations they have given? Sales. Fine. We have gross profit 25% on cost. 25% on cost. Fine. 8 lakh into 25 and 25 divided by 125. It comes out. We will actually brought down the gross profit, right? Here in the P&L account, gross profit. It comes here, right? Gross profit some amount, and we will brought it down. How much it comes out? 1,60,000. 1,60,000. Okay. Then operating income. Is there any income? No. Then we have operating expenses, not non-operating, operating expenses, office and administration expenses, and selling and distribution. Office and administration expenses, how much it is? 20,000. No. To operating expenses. We'll do it in the outer column. Office and administration. 20,000. Selling and distribution, how much it is? 28,000. Totally operating expenses comes out 48,000. Next, the balance will be the operating profit. And we have one more thing, a loss by fire. It is non-operating expenses. expenses we won't consider here. Okay, 48,000, how much it comes out? 1,60,000 minus 48, 1,12,000. 1,12,000 is the operating profit. That's it. 1,12,000, is that correct? Divided by 8 lakh into 100, it comes out 14%. It comes out 14%. Fine, we go for the next ratio. Yes, the next ratio we have operating ratio. Operating ratio means we will compare our expenses to produce the goods, and we will compare with the sales. We will compare with the sales, right? Why will compare? How much expenses we are making to sell a goods or to produce a goods to sell, right? Let's say if you are expensing 60%, remaining 40% is your income. If your expenses are 80%, remaining 20% is the profit. This is the calculation we are going to do. What is the profit we have? Or will not calculate profits, will calculate how much percentage of expenses we are making, how much of percentage of expenses we are making, that we will calculate in this ratio. Let us read the question first. Sales, they have given 6,80,000. Gross profit 25% on cost, fine. Selling expenses and administration expenses. Calculate operating ratio. Fine. What is the formula? Cost of goods sold plus operating expenses minus operating income divided by sales into 100. Straight away, I think they have given sales 6,80,000. Is it? Yes. Yes. Gross profit. Okay, we need cost of goods sold. Cost of goods sold is equal to sale minus gross profit. Right. Sale minus gross profit. Fine. What is sale? 6,80,000. Out of that, gross profit, do we know? No. They have given 25% on cost. 25% on cost means into 25 divided by 125 we do. We'll get the gross profit. 6,80,000 into 25 divided by 125. It comes out 1,36,000 gross profit. Gross profit. If we minus the gross profit from the sale, 1,36,000, right? Remaining 5,44,000 is the cost of goods sold. Then 5,44,000 plus operating expenses. These both are operating expenses. 1,44,73. 1,44,000 plus 73,000. 7,61,000 is the cost of, sorry, whatever the expenses we have made is 7,61,000. If we made expenses 7,61,000 and the sale is 6,80,000, it means we are in loss. Into 100. How much it comes out? 7,61,000 plus 6,80,000 into 100. No, 7,61,000 divided by 6,80,000 into 100. Yes, it comes out. Yes, now it's correct. 111.91% is the expenses. Means we are having 11.91% 11.91 percentage of loss. 11.91 percentage of loss, additional loss. Right, the question is done. You can take down the question or solution. We'll move on to next question. Yes, the last one in our chapter is return on investment ratio. Return on investment ratio. What do you mean by return on investment ratio? Whatever you made investment or you put up a capital in a business, for that capital, how much percentage you are earning, that will be calculated in the return on investment ratio. Is that okay? Yes, fine. What is the formula? Profit before interest and tax. Profit before interest and tax divided by capital employed into 100. Divided by capital employed into 100. Fine, 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 fine. Let's see the question and understand the formula. Right? Okay. Net profit after interest and tax. Net profit after interest and tax. But we need profit before interest and tax. But they have given net profit after interest and tax. Rupees 1 lakh. Current asset. They have given current liability, fine, tax rate. Fixed asset 6 lakhs. Long term debt 4 lakh. That's it. Calculate return on investment. Shall we write the formula? Yes. What is the formula? PBIT divided by what it is? Capital employed into 100. So, what is capital employed? What is capital employed? It is shareholders fund. It is shareholders fund plus reserves and surplus. Reserves, sorry, reserves and surplus. There is another way to calculate the capital employed. Right. In balance sheet we have shareholders fund, non-current liability and current liability. Fine. Non-current asset, current asset. One way is this shareholders fund plus non-current liabilities. It is, sorry. One way is adding these both. We have done that. We know that. Another way is non-current asset plus current asset. Non-current asset plus current asset minus current liability. Minus current liability. What it is? Shall I write? Non-current asset plus current asset minus current liability. So what it is? Current asset minus current liability. If we do that, we get working capital. And now we can write that non-current asset plus working capital is capital employed. Shall we solve the question? First, we should know the profit before interest and tax. So, we need profit before interest and tax. Fine. From this, if we minus interest, we get profit before tax. Then, if we minus tax, we get profit after tax. Is that correct? Yes. Fine, sir. Fine. They have given profit after tax. Where it went? Yeah. 1 lakh rupees they have given. Fine. Okay. Tax rate is 20%. Tax rate is 20%. 0.20x, we can keep it. Okay. fixed asset. Fine, 1 second. 10% long-term debt. 10% long-term debt of 4 lakh. Interest is 4 lakh into 10%. Is that correct? Yes, 40,000 is the interest we should pay. Fine, we can keep it as x, profit before tax as x, and if we minus tax from this x, 20%, remaining 0.80% is the profit after tax. Is that correct? Is that correct? Yes. If it is 1 lakh, if you want, you can straight away put the 80%, or you should solve this. It comes x is equal to 1 lakh divided by 0.08, like this it comes out. But you can take this straight away, 80% divided by, if we do 80%, what it comes, 1 lakh divided by 80%, 1,25,000 profit before tax. Out of that, if we minus 20% of tax, it is 25,000. It comes out 1 lakh rupees. If we add these both, we will arrive at profit before interest and tax. Profit before interest and tax, how much it is? 1,65,000 total. From 1,65,000, if we minus 40,000 of interest, we will arrive at profit before tax 1,25,000. Out of that, if we minus 25% of tax, 25,000, we will arrive at profit after tax 1 lakh rupees. Profit before tax we got 1,65,000, 1,65,000. Is that correct? Yes. We should calculate capital employed now. Capital employed, what is the formula? We can take this formula, right? Non-current asset, what is there? Yeah, fixed asset is there. It is non-current asset. Fine, non-current asset plus current asset, fine, minus current liability also they have given. That's it. Okay, current asset, current liability, current asset, current liability. Fine, how much? 6 lakhs plus how much current asset is there? 4 lakh minus 2 lakh, it is comes out 8 lakh rupees. Capital employed is 8 lakh, profit is 1,65,000. Profit before interest and tax is 1,65,000. 1,65,000 divided by 8 lakh rupees into 100. 20.625. So if we invest rupees 8 lakh, we get 1,65,000 as profit before interest and tax. If we invest 100 rupees, we get 20.625 rupees as profit. Is that correct? Yes, you can take down the question. By this, we are completing ratio analysis chapter. If want, we can do more questions. Let us see if it requires or not. Yes, we got completed. We'll meet in the next chapter. Until then, bye.